Hey everyone, welcome back to another dividend investing video. With the halfway point of the year 2023 upon us, this is an ideal time to look at the portfolio we're building here on the channel and evaluate the top 3 positions by performance. The portfolio is having a nice June so far. Many of my positions are up. I want to take a look at the 3 top performing stocks and evaluate what I want to do going forward with these positions. I have no intention of selling any of them. I believe if you are long term, you let your winners run. I'll let you know where I see these stocks right now, and most importantly, if I'm going to continue adding to these positions in the near term. So let's get into it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So the portfolio I'm building up on the channel, I've got a whole series on this, a playlist, and I'll leave the link to that in the description. These are usually popular videos for my channel, so if you're seeing this, you're probably familiar with this Fidelity account. It's about 9 months old, and with weekly contributions, we've brought this account balance up to $9,500, almost a 5-figure portfolio, just a couple more weeks will be there, right? Now my strategy has been to dollar cost average into a combo of broad diversified ETFs and dividend growth stocks that I have a strong conviction on for the next decade and beyond. There's about 25 positions in here total. Notice my VOO holding is up 11%. And this is from dollar cost averaging for the last 9 months. So we are in something of a bull market now. And this is when I'm going to start getting selective about which of these positions I'm adding to. Basically the ETFs, I'm going to continue dollar cost averaging into. That's SCHD, VYM, and VOO. I'm happy with this mix of ETFs. But for the individual positions in here, I'm going to add when we see value for the most part. Some of the more fair valued quality blue chips here, I'm going to build up slower. And the ones that I see as holds, I'm simply going to continue to hold and drip. And I think this is diversified enough that there's going to be enough positions that I'll always have a couple that I can add to. And the rule I'm implementing here is this. No one individual stock position will be more than 5% of the portfolio. And the ETF portion of the portfolio, I aim to keep around 30%. No less than 25% ETFs. So let's talk about my top 3 performers here. I can sort my spreadsheet here by gain, and those top 3 are Broadcom, ticker AVGO, Comcast, ticker CMCSA, and SnapOn, ticker SNA. So if all you cared about were what my top 3 performers are, that's the list. But I'm going to go into these and show you what I plan to do going forward. Real quick. The biggest runner in my account has so far been Broadcom, ticker AVGO. This is the semiconductor stock in the tech sector. I'm up huge, 53.13%, and this is from dollar cost averaging. Literally every month I buy a little more. Today's shares of Broadcom are trading at $868.11 per share, just a tad off its 52-week high. Year-to-date shares are up 56.85%, outperforming the rallies we saw with Apple, Microsoft, and Amazon, etc. And in the last month, shares are up 35%. Over the last 10 years, total returns from Broadcom completely destroyed the S&P 500, returning 2,880% between price appreciation and dividends, while the S&P 500 returns were at 228%. Ladies and gentlemen, this is why I mentioned you let your winners run. Amazing. In the short time with this rally, shares have become overvalued, unfortunately. The forward PE of 20 is 30% higher than its 5-year average PE of 14. And today's shares are yielding 2.12%. My own yield on cost is 3.25%. 3.25% is also Broadcom's 5-year average dividend yield, so today's shares are yielding 35% above that 5-year average. The dividend does remain safe looking, making up 42% of forward earnings, and more relevant, it makes up 39% of forward free cash flow. Remember, free cash flow is a lot harder to fudge than companies' earnings. I think this is the better picture in most cases. In this case, they're about in line, which is a green flag. You want to see earnings and free cash flow generally be in alignment. Now, from a dividend growth perspective, looking wonderful. We have 12 years of dividend growth, and the dividend has been growing at a rate of 29% annually over the last 5 years on average. The latest increase back in December of 2022 was a 12% bump. Analysts see no short-term upside. The price target currently represents 1% downside from its current price. Maybe the analysts need to catch up. I'll keep you guys in the loop on this. For the most part, I was buying Broadcom at what I considered fair value over this period of time. Even points I thought it was somewhat undervalued, which I highlighted back in November in a video. This is a high-quality company. I believe in it for the next decade. At the current moment, I'll be holding and I'll be dripping this position. I would like to grow it more, and that is the plan, but we're going to need to see a little bit of correction or see it fall back into at least the fair value range. This is one that I'm very happy to buy and hold at a fair, reasonable value. The second top performer of the portfolio this year is Comcast, ticker CMCSA. They are in the communications sector in the cable and satellite industry. In my own position, from dollar cost averaging small amounts over the last 9 months, I'm up 15.39%. And today shares are trading at $41.20. Shares have appreciated 15.83% over the last year. If we look at the total return over the last 10 years and putting up against the S&P 500, we'd see that Comcast has underperformed the broad market, returning 156%. Versus the S&P 500's 228% over that time frame. Now, shares of Comcast have recovered some, but let's see how timeliness looks right now. The PE of 11.2 is 19% below the 5-year average of 13.9, suggesting the stock could still be in undervalued territory. Now, shares of Comcast are yielding 2.82%, which is 34% above the 5-year average of 2.1. So we are undervalued also by the dividend yield theory metric. The dividend looks to be secure, taking up 31% of forward earnings, and more pertinent, 36% of forward free cash flow. The dividend has been growing for 14 years and grew during the last recession. Its latest raise was announced 7.4% over last year's dividend payment. Wall Street analysts see continued upside for Comcast with an average price target of $45.55. This represents 10.56% upside from current levels. So here's my plan with Comcast. I'm going to continue to add to this position. It looks like a deal to me still, undervalued by most metrics with a safe growing dividend. It is one of 2 I own in the communications sector in this portfolio next to AT&T. And this one has performed far better, has superior dividend growth prospects so far. Even though I'm up 15% on Comcast and down the same amount on my AT&T position, if you gave me $100 to invest in either one today, it would easily be Comcast, no questions asked. So my third best performing position in the dividend growth income portfolio is SnapOn Incorporated, ticker SNA. It's part of the industrial sector and in the industrial machinery and supplies and components industry. Now my own position in SnapOn is up 14.9%, nearly 15%. Same as the others, I've just been adding small amounts into this over the last 9 months and building a position up. Year-to-date shares of SnapOn are up 19.4%, and today they are trading right around the 52-week high of $275.87. If we look at the last 10 years and put SnapOn up versus the S&P 500 from a total return perspective, SnapOn has outperformed the broad market 271% to 228%. From a forward PE perspective, SnapOn is trading in a 15 forward PE, close to in line with its historical norm, looking close to fair value. From a dividend yield perspective, shares are yielding 2.37%, and this is about 8% lower than its 5-year average. So again, we aren't getting SnapOn at a discount right now, but it's not too far from a reasonable fair value from that dividend yield theory metric as well. My own yield on cost is 2.72%, right? So the dividend for SnapOn does appear to be secure, taking up 35% of forward earnings and more relevantly, 36% of forward free cash flow. I'm happy to hold this one and collect that sweet, sweet dividend. SnapOn is another one of the strongest performers in my portfolio in terms of dividend growth. The latest dividend raise announced was at 14% last November, and that's about in line with how this dividend has grown in the last 5 years. 13 years of dividend growth, 84 years of uninterrupted dividends. So the dividend was not cut in the last recession, it was maintained. Wall Street analysts don't see much upside here for the next year. Its price target is $250.23, which is 8% downside from where it sits today. SnapOn has come up quite a bit. At these levels, I call it just above fair value. I think it's an extremely quality dividend growth stock that does all the things I like to see as an investor, so I'll more or less continue to dollar cost average into this one slowly. And of course, I'll reinvest those dividends. So if you're keeping score, if someone gave me $100 and said, buy one of these 3 stocks I talked about that are my winners, I would be easily picking Comcast based on where things stand today. I think that one is the one that kind of sits in undervalued territory, while SnapOn is in a fair valued, maybe a little more in fair value, and Broadcom is in overvalued territory, unfortunately. I'm definitely not planning on selling any of these three positions. I intend to grow them. I'm going to be more aggressive about it when I see opportunity, like right now I see that in Comcast. Now thanks so much for sticking around. Your support means so much to the growth of my little channel here. We're just getting started here. About to cross that 16,000 subscriber mark, and I thank each and every one of you from the bottom of my heart. It really means so much to me. If you're wondering what stocks I think look best in June right now, I invite you to click into this next video where I go over my top picks for that month. I've actually purchased 3 out of 4 of these stocks since releasing the video. So cheers, my friends, and until next time, keep investing.